Hi everybody, welcome to another STANLIB webinar. In this webinar we're going to focus on STANLIB's Income Fund. There's a huge amount, I think, to unpack, some exciting stuff. Certainly a delve into not just the yield curve, interest rates and inflation, but also look at some of the issues around credit. And so in order to unpack that, we're joined by Victor, who is the head of fixed income in STANLIB, as well as Tarryn, who's the head of credit. And together they're going to go through a series of charts that explain what's happening in the income fund, what the structure is, what the performance is, and why you should be invested. And I think it's certainly done well. It's certainly an attractive product under current circumstances, and I would urge you to have a look at it and consider it within your portfolio. So if we look at the agenda in a bit of detail, we're going to spend about an hour going through the discussion. I've been given all of 10 minutes. I've been told I can't go over 10 minutes, so I'll be watching the clock. And in those 10 minutes, I'll do a kind of macroeconomic update. I'm not allowed to use charts, otherwise I just talk too long. So I'm going to keep it fairly confined and try and make the points fairly concise. So you've got me for around about 10 minutes, and then Victor and Tarryn each have got around about 15-20 minutes each. They're going to go through some of the charts and give you some feel and flavor around the issues revolving to the income fund. And then we've got, I'm hoping, a decent chunk of time for some question and answer. Obviously, I'll have some questions, but please, I urge you, as we go through it, type up your questions. We'll send those through, and I'll try and ask as many of those as we can. And then I'll come back at the end for a close. We're going to ask Victor, before I get there, to summarize the essence of what we've said today. So maybe look out for that. Please, in terms of some of the housekeeping things, if you want CPT points, you've got to stay online for the entire duration of this discussion. We've applied for those CPT points, and those will be available in due course. Also, please, if you want a copy of this video, it will also be available in an email form. We'll send that to you when we say thank you for attending the function today. And from my perspective, I know there's a huge amount of choice out there. There's a lot of webinars, a lot of companies vying for your attention. So from our perspective, thank you very, very much for joining in, and I hope it is of some value to you today. And please, guys, if you're looking for any other additional information, stuff that we haven't provided, or you want us to have a look at a specific issue, let us know and we can maybe put that on the agenda. We're certainly receptive to any ideas that clients put forward. And I'm constantly searching for feedback on what sorts of things you want to see us covering and discussing. All right, so in terms of the macroeconomic backdrop, geez, there's a lot going on. Internationally, there's a lot. Locally, there's a lot. You'll be pleased to know I'm not going to talk about Russia. I'm not going to talk about being on a plane for hours on end or a ship docking, none of that stuff. What I'm going to focus on is really some of the big economic issues that the world is confronting. And obviously the biggest of that is the inflation discussion. It's been around for a long time. It does appear to us that inflation is dissipating, or at least the pressure is dissipating. We can see that in a whole range of numbers. If you think back to the US, they got inflation up at 9.1% June last year, 9.1 versus a target of 2%. They've taken that all the way down to 4%. So that's a significant improvement, and you get a feeling that they're on their way down to the target, right? The problem is, of course, that they're not at the target, and they've got some work to do. And the Federal Reserve made it clear, I thought, last week, that they feel they haven't put enough interest rate hikes in place in order to achieve that target. And so the message coming back from the Fed is, we're going to hike rates further. So you would factor in at least another one hike in July. You would argue that there's a distinct possibility of a second hike in September, and then hopefully that's it, they're done. And then they probably adopt a wait-and-see approach, waiting for that inflation rate to keep tracking lower, instead of 4% to head closer to the 2%, and then they can start to cut rates. Now, for me, what's critical, it's very unlikely that the Fed will cut rates until they are assured that they're going to get back to the target. In other words, let's say that inflation is 3.5% or 3.3%, something like that. And the argument is, geez, we're close to the target. Interest rates have been high for a considerable time. The economy is taking a bit of pressure. We need to cut interest rates. I just don't think that the Fed capitulates. I don't think the Fed says, we're close enough, we might as well start to cut interest rates. They only do that, in my mind, when they are assured that they're going to get to the 2%. That doesn't mean that they have to wait until they get to 2% before they cut rates. They can cut with inflation above 2%. They just need to know that they are going to get to that target. I think that happens during the course of next year. I think by the middle of next year, the Fed should be cutting rates. And I think when they start to cut rates, they can push through quite aggressive cuts and get interest rates down to around about 1.5% above inflation. So that's a considerable move. If you think that they're over 5% at the moment, they can effect some substantial reduction in rates. When I look at the other central banks, they're also still in interest rate hiking cycle, right? The ECB hiked rates last week, 25 basis points. They made it absolutely clear that they're going to hike rates further in July, another 25 basis points, and possibly beyond that. So I think that you've got hikes going through there. Not long ago, the Bank of Canada, which was on pause in terms of interest rates for 4 months, where they felt, we're at the top of the interest rate cycle, they got caught out. Inflation has become problematic again, and so they've resumed interest rate hikes. Australia has gone with interest rate hikes. So we're still in, globally, an interest rate hiking cycle. The one country to perhaps mention as being distinctly different is China, obviously. China actually cut interest rates last week, only 10 basis points, but they cut rates. The inflation rate is incredibly low and in deflation. And their problem is that growth is slowing. They keep hoping for this acceleration in economic activity, and it's just not materializing. And so China feels they've got to provide stimulus to get their economy going in a more significant way. And so part of that stimulus is a cut in interest rates. I think they'll add to that stimulus with other spending programs, including infrastructure, including some spending on the housing market. So China is an exception, and I don't think we should look at China to say, well, that's what we should be doing. I think they are in a completely different dynamic. Likewise, you would argue Japan, also completely different dynamic. They've got what we call ultra-loose monetary policy, and it looks to me like they're going to keep that in place, and they obviously haven't had to tighten interest rates. But the major economies still hiking rates, still waiting for inflation to come down. I think inflation will get there. There's some specific reasons why inflation is stubborn. In some countries, it's food prices. In the US, it's got a lot to do with shelter inflation, basically housing inflation. But I'm confident that those numbers will dissipate, and that will allow the Federal Reserve to start cutting rates. And we know that that's an important signal around the world, including for the South African Reserve Bank, to also look at interest rate cuts. And hopefully our Reserve Bank reacts before the Federal Reserve. I think our inflation rate will be inside the target before we get to the end of this year. What about the growth dynamic around the world? There's no doubt that world growth is under pressure. I'm seeing quite a lot of forecasts to the downside. China recently, a lot of forecasts there to the downside. The US flirting with the prospect of going into a recession. Victor will talk about that a bit later. The probability of a recession is high, and so we're still waiting to see what is the damaging effect of putting interest rates up the way that the major central banks have done. So far, that damage isn't that evident, right, in the data, especially in the US data, because the labor market has held on. The number of jobs being added is very significant. If you look at a whole range of services, leisure, entertainment, retail sales, all of those numbers have held up. Yes, there are parts of the US economy that are weak and weakening, but in total, the US is not in a recession, and that's part of the dilemma for the Federal Reserve. I think they would ideally want to see the economy weakening more. They would want to see the unemployment rate rising and take some of the froth out of the US economy, and then they would be more assured of getting back to that inflation target. I think we're going to get evidence of that. I think that we'll see some of this economic data weaken further, second half of this year into next year. So all of that is ahead of us. It's not a great backdrop. But I'm going to talk about, when I talk about South Africa now, I'm going to talk about where I think some of the positives can come from. And geez, it's been difficult to talk about South Africa in the last couple of months. The presentations we've done have been extremely challenging. We've struggled to find any sort of positive. And I think we're starting to see a resemblance of some positive indicators that we can talk about legitimately, instead of trying to just make up stuff and come up with ideas that are half-baked, that are not necessarily all that convincing. So let's turn to South Africa quickly. I've only got a minute or so to get through South Africa, maybe 2 minutes if the producer is generous. But in terms of South Africa, our inflation rate has come down. We're well below the peak. I think our inflation will keep coming down. As I said, I think we'll be inside the target by the time we get to the end of the year. I don't think we're going to be at the 4.5%. I think that's going to take us into next year. Does the Reserve Bank have to hike rates? Yeah, yes, I think they probably go again, partly because the US Federal Reserve is indicating they're going to hike rates further. So you would, to be conservative, you would say there's probably another interest rate hike due for South Africa, 25 basis points. And then hopefully that's it. I think interest rates have gone up enough. I think they're in restrictive territory. I think they'll do their job together with other factors. And I think we'll get inflation inside the target enough to satisfy the Reserve Bank, and so they can start to cut interest rates. I don't think that happens this year. I think they wait until next year, until they're more assured, again, that inflation is under control. But hopefully we start to get those interest rate cuts coming through next year. And we could find ourselves in a global economic cycle where most central banks are cutting rates as we go through or deeper into next year. In terms of our growth dynamic, it looks dreadful, obviously. The growth forecast for this year is 0.1%. That's essentially no growth. We keep flirting with a recession. To be positive, though, think about it. We've had a lot thrown at us. We've got this extreme load shedding that we've been dealing with, higher interest rates, a lot of loss of confidence, currency all over the place, yet the economy is actually not in a significant recession. And that tells us there's a resilience in the South African economy. And I think that resilience is coming about because companies haven't responded to this environment by simply cutting jobs. I think they've been reticent to cut jobs. I think they're holding on to skills. I think they're more mindful that if you cut jobs, you've got to go find individuals later on when the economy is doing slightly better. And that's not so easy to do. So I think there's more maturity in our corporate sector. I think they're aware of the circumstances and they're adopting more of a wait and see approach, but it's good news in terms of the labor market. And that's giving this economy a little bit of a resilience. It doesn't mean that we've got vibrant growth, far from it. 0.1% is extremely weak growth. The unemployment rate will be under pressure, a whole lot of pressures. But we at least seem to be avoiding a significant recession. So to finish off with, where do I think some of the positives are? Let me give you a scenario. I don't think it's a huge stretch, right? So if you look at the load shedding, it has eased off. There's specific reasons for that, including that simply the power stations are breaking less. So maybe, just maybe, some of the maintenance has helped. There are other factors at play. I won't go through all of that, but we've eased off on load shedding. So let me give you a scenario where, let's say, during the course of the rest of this year, we fix the 4 units at Kusile. That brings back quite a lot of power. We fix Medupi Unit 4 during the course of next year. That fix is underway and it should be finished by the middle of next year. That brings back more power. What that would do is allow us to ease back on a consistent basis in terms of load shedding. It doesn't get away from load shedding, but it takes it down substantially, and we're then in a much better environment. And obviously that starts to add in terms of confidence and some economic activity. Let's assume that the Reserve Bank is cutting interest rates next year because inflation's under control. That's certainly our baseline. Let's also assume that as we build up for the election next year, there's a whole lot of spending that happens, partly from government that wants to beautify the place, make the place look a little bit prettier, do some service delivery. That is a little bit of spending. And then I think about all of these political parties that want your vote. They're also going to be spending money, mainly on T-shirts and posters, but hey, it's spending money and it gives us a little bit more economic activity. All of that together with some deregulation that continues to evolve. And I'm encouraged by discussions we've had with the President's office regarding some of those deregulations, and I think they'll result in some move forward, particularly watch Pier 2 Harbour Durban. I mean, don't actually go to Pier 2 Harbour and watch it, but just watch the developments around Pier 2. And I think what you're going to see is private sector taking over the management of that harbour. And that would be a very clear signal that government is more willing to step back from some of these areas where there's been extreme mismanagement. So I could see an environment where next year, less load shedding, interest rate cuts, a bit more confidence, and the economy is doing better. Throw in a global environment where you've got interest rate cuts internationally, and we've got the makings of a more decent economic upswing that takes us over the next, let's say, 12, 24 months. And so I've become more encouraged by the outlook. I think we're at the point of maximum pessimism. And I think we've got to acknowledge that through the winter months, understandably so, but I think there's some prospects to be a little bit more optimistic. So with that as a backdrop, what I'm going to do now is hand over to Victor. Victor will use some charts and go through what his thinking is around the income fund, some of the macro issues, and then Victor will hand over to Tarryn, and I'll be back at the end to pose some questions. Thanks a lot, guys.
Thank you very much, Kevin. What is clear, I mean, from Kevin's introductory remarks is that even though the picture for South Africa might get a little bit better next year and maybe also into 2025, the reality is that there is still a lot of unknowns, I mean, that have been playing out, in the market, and those unknowns have created a lot of volatility, for the markets, and most of that volatility has also been created by central banks' actions, and also, I mean, the way that governments, I mean, have responded, to different issues since we've had COVID, and central banks have been struggling, I mean, to even forecast where, for example, inflation is going. You will remember last year around this time, or maybe just before this time, I mean, last year, central banks were still talking about inflation being transitory until they realized that it's actually gonna be a bit stickier than they thought. And then they had to increase interest rates quite aggressively. I mean, to an extent that we are only seeing the first pause, I mean, after 10 consecutive hikes by the US Federal Reserve. And as a result, emerging markets, I mean, couldn't stand by, including our South African Reserve Bank, I mean, which also had to increase interest rates, I mean, quite aggressively in order to be able to not fall far behind and lose credibility in fighting inflation. And all this, I mean, is because the playbook, for the current market movements of the playbook, I mean, for the current economic outcomes, I mean, that we are seeing, it's not the same as the one that we were used to. You can't just simply extrapolate, I mean, what has been happening over the last 10 years, and then you think you're going to get a decent outcome at forecasting. If anything, when you're looking at this crisis, you need to go back to 1980, where the global world, I mean, was struggling with inflation, almost like a stagflationary environment. And then we also had, I mean, a similar kind of volatility like we're seeing, currently. So, and I've got a couple of charts, I mean, which I'm going to use to latch on what Kevin was talking about earlier on, and then talk about the portfolio later on, with Tarryn coming, I mean, later on to bring a bit of a bottom up, on the instruments, that we manage in the income fund. But the main message, I mean, for this presentation is really around how, I mean, our clients, can navigate a very difficult environment, which at times, I mean, you would think things are going to improve, and then all of a sudden, I mean, you're constantly getting hit by surprises. So you can imagine, I mean, if the central banks that have got very big models with lots of variables in analyzing all this information have been struggling for quite some time to capture this. So you can imagine, I mean, US investors, how difficult it might be to do that. But fortunately, for investors, there are instruments and portfolios that they can invest in to try and ameliorate, I mean, the impact of that. So the picture that I'm showing on this slide is basically how interest rates have actually increased at the fastest pace in a long time, and of which, some of that it's still going to have an impact on the economy. And then on the right of this graph is the probability of recession that Kevin talked about. What is clear is that previously, when those probabilities went towards 50%, certainly, we've had a recession of some form or not. And recently, because of some reasons that Kevin gave, around labor markets and all of that, those probabilities have gone to 75%, and we still have to enter into a recessionary environment. So in my mind, if the US Fed and central banks are going to increase rates to fight inflation, and basically also increasing rates at a time when inflation is starting to decline, also in the US, we can agree that it's sticky, but the reality is that it's also starting to decline. And previously, when they have done this, in 1980, for example, we've had a recession, and then it was followed by, we've had a technical recession, which was followed by a protracted recession in 1981, 1982. So on this graph, basically to show that inflation, it's starting to decline. If I can drink my water. It's starting to decline towards that 2%, but it might actually take longer for South Africa. We're going to be getting into the target zone that the Reserve Bank set itself. So the Reserve Bank has been hiking rates, similar to what all of the Reserve Banks, globally. The reality is that because they want to fight inflation and they see inflation as a bigger beast, there's a high probability that they keep, when they get to the top, maybe the last 25 basis points that they might do, they keep rates low at higher levels for longer. But if you look at that inflation profile that I showed in the previous slide, with inflation coming down to, call it maybe 4.5 over time, the reality is that the real rates are going to be much wider than you have seen, previously, which can also create the potential for slowing down, some of the benefits that Kevin talked about earlier on. And all of these challenges have been happening at a time when foreign investors have been turning their back, on South Africa for various reasons, including the politics, to such an extent that when other emerging markets that we compare with have been benefiting or not losing much, South Africa has been isolated, over the last few months, largely because of shooting ourselves, on the foot. And the graph, on the right there, basically showing how much foreigners have reduced their exposure to South Africa from 43% to 25%. So the challenge here being that with the terms of trade now, starting to turn the other way, it becomes very difficult to protect the currency if the commodity cycle turns. And if these terms of trade, continue to move the wrong way, and you don't have portfolio flows, that we've been getting to balance our budgets and to balance also, our current account deficit, the risk that you get, is that the currency, the South African currency, might actually remain weaker for a while longer. And if it does, you might end up also entering that space where Canada, for example, found itself having to increase rates when they thought they are done. But I'm not saying that that's the central case. But it's basically just to highlight that if there's one area that we need to watch, it's basically what happens to the currency. Because the Reserve Bank, although they won't admit it, the reality is that they want a stronger currency, which can actually be able to protect the inflation trajectory. So all this volatility that I've talked about has been playing out in the equity markets. Yes, you've had some benefits here and there, but what you have to admit is that there were times where there were massive sell-offs. In the market. So these are the interest rates moving higher quite aggressively. So for a portfolio like this, you've had to manage the modified duration of the portfolio, which is what I'm showing on this slide. So we cut down the modified duration from over 1 year previously down to 0.4 years, meaning that the portfolio is protected every time. I mean, you see those interest rates hikes. I mean that we talked about earlier on. On this slide here, it's basically talking about the yield that you would get on a portfolio. So this is the right portfolio to be in the current environment, because you earn more yield and you have less capital volatility on the fund. With the rate hikes that we've seen recently, and also including maybe the last 25 basis points of increases that might come through, you might see that yield, I mean, getting up to 1040 level, I mean, which is a decent current yield return, I mean, on the fund.
Can I just interrupt me? Can you go back one chart? I just want to make this point, right? So you're talking about a yield here of 10%. Effectively, you're talking about a return that is close on double digits in an environment where inflation is coming down, and we've got inflation getting inside the target range over the coming months, pretty much getting down to the 5%, potentially a bit below 5%. So in real terms, if I think about the real return, that's impressive. And if I think about the risk, I mean, Tarryn's going to talk about some of the risk, but if I think about the risk that's inherent in this portfolio, it's very modest in relative terms. So you're getting 5% real for very little risk. Am I right with that?
And that's the message, basically. I mean, on a portfolio like this, you know, you're getting income, you don't have any risk. I've got a slide that I'm going to show, I mean, immediately after this, which basically demonstrates, I mean, that point that we have, if I can move to this slide. So if you look, I mean, at this graph, this is the return versus risk, you know. So the red dot is basically where the total return for the income fund is, we're forecasting it to get to over time as interest rates move higher and the floating rate instruments reprice higher, you know. But look at the volatility of the portfolio. It's actually quite small, especially when you compare it to a typical bond portfolio, which would be the light blue dots, I mean, in the middle, and also if you compare it with returns that you would get in equity investments. So you're kind of like getting to that space where soon you're going to be getting annualized, I mean, 10% return when inflation is basically coming down. And this graph also, I mean, demonstrates exactly what you're talking about, Kevin. Here I'm using the historical performance of the income fund versus maybe a riskier portfolio like maybe a fixed instruments, basically, you know. So what is clear is that on the left, the green bars are the ones that are dominating the returns, and then the light blue are actually quite small. But if you were invested on a riskier portfolio on the right, like the bond portfolio, yes, you do get the income, which will be about 10%, but you also have to stomach a capital loss that sometimes can be over minus 7%. That can sometimes be around 7%. So a point maybe also, I mean, just before I give the clicker to Tarryn, is that if you look at this year, I'm just looking at the first 5 months. The income fund on this graph, the one before this, the income fund on this graph, you can see the income fund is the one on the left. You can see the horizon returns, and from January up until May, the green line is dominant, but the capital impact with the sell-off that we have seen because of South Africa's specific issues and us being isolated to other emerging markets is actually quite small. But if you go to the right, you know, and you were invested, say, I mean, I'm a bond manager, so sometimes I might sound like I'm tracking myself out of a job, but I'm using this basically to demonstrate different risk profile for investors that are looking, I mean, for different products. If you were in this product, the light blue line, I mean, which goes below the zero line, that's the capital impact that you would have had. I'm talking about the last bars, I mean, at the end, which says 2023. So you would have had over 5% of capital depreciation with less income for the same period. Yeah. So that's where this portfolio actually plays well in an environment where there's a lot of volatility, and your returns tend to, currently there's a problem with my, okay, maybe you want to click it from your side, Tarryn. It's not clicking. Yeah, and your total return on this portfolio is the blue line on top, over 5 years. Basically, if you gave me 100 rand, 5 years ago, we would have grown it to 145 bucks. If inflation would have grown to 127 bucks, and the benchmark for this would have grown to 132 bucks. So compelling returns, you're gonna get to the 10% level with low volatility of returns, as you can see. I mean, how that line grows, I mean, over time, kind of like similar to what you would have in a money market portfolio.
So from my perspective, Vic, the income fund has done well over a period of time. We know that, but I think what is maybe useful to point out is that it's well suited for the current environment.
Yeah.
That doesn't necessarily apply to all parts of the yield curve, but the specific circumstance we find ourselves in at the moment, where inflation's coming down and interest rates are still high, and that balance is likely to remain in place, then income fund is offering a very good return. It will change.
Yep.
There will be different circumstances, and
Yep.
we'll talk about other funds that are perhaps more attractive in
Yep.
time. But right now, income funds is certainly a good place to be, as long as we're comfortable with the risk in the portfolio, which is what Tarryn's here to talk about,
Yes.
right?
So you're more likely to go back, if you look at the income fund graph before COVID, for example. I mean, the returns were closer to the returns that you're basically getting now. But around that time, inflation was basically around 4.5% in South Africa. So that's where you're getting to. And that gap, the larger that gap gets, the better for the clients, because it means they don't have to dip into their capital in order to prefer the same lifestyle, that they've had before.
Sure.
So quite compelling, lower risk, and it's a good diversifier also. If you're looking to diversify your portfolio along with your other risky assets. So yeah, it's got a place for a multi-asset portfolio. It also has a place for clients that are only looking at this in lieu of cash, for example.
Yeah, so you want to be in this certainly relative to cash, relative to a money market. Absolutely, you want to be in this.
Exactly.
Okay, so Tarryn, tell us about the risk inherent in this. What are some of the credit risks that we're dealing with?
Thanks, Kevin, and thanks, Vic. So I thought it might be helpful to just reintroduce credit as an asset class. So when we talk about credit in the context of the income fund, what we're essentially doing is we are lending to corporate and financial South Africa. And why do we do this? Because we're able to generate a return for taking on these specific credit and liquidity risks. And so our credit process really is obsessed around making sure that that risk is well managed, and that we are adequately rewarded for bearing that risk. So the two questions that I'd want to answer today, really, given the macro backdrop that Kevin sketched for us and the performance of the fund to date, is, what do these global and local macroeconomic conditions mean for South African credit? And secondly, what does well-managed risk look like in this environment? So moving to some of the charts, the main takeaway here is that globally, risk is rising. Kevin's outlined it in terms of the risk of recession, or at least a slowdown of some sort. And so what we're seeing here is the number of issuers that have had downgrades of 7 notches or more, according to Standard & Poor's, a global rating agency, is at the highest level it's been since 1981. If you have a look at the dark blue bar, you'll see more than 50 corporates have had rating downgrades of more than 7 notches in 2022. And so clearly global risk is rising, and it stands to reason given the macro backdrop that we've spoken about, interest rates rising and the risk of kind of a recession or a slowdown of some sort. Another manner in which some of these credit risks manifest in response to the macroeconomics is when we look at the global default rates. And so what this graph looks at is it's a default study. So rating agencies, the like of Moody's and Standard & Poor's, they conduct, at least on an annual basis, reams and reams of data analysis on the number of corporates that have defaulted, the value of debt that's defaulted, and the link between macroeconomic conditions and the risk of default. And if you have a look at the graph, you'll see that on average, defaults have been generally below the historical average, and that's really been supported by very loose monetary policy conditions, easy money, lots of liquidity in the system. And as we move through this next phase of the interest rate cycle, with rates rising, as Kevin alluded to, still a lot of fighting to be done against inflation, it stands to reason that global defaults are likely to increase. And so what this graph shows is Moody's Analytics expectation of what that default scenario could look like. So on a baseline, they see it moving to 4.9%, relative to a global average of about 4.1%. So it's a modest increase in defaults. And if you compare that to the 2008 global financial crisis, for example, there we saw defaults in the region of 10% on average. So certainly there's pain to come or to be felt really when it comes to global credit, but not necessarily on the same scale and order of magnitude as what was possibly experienced under the global financial crisis. And so what does all of this mean for South African credit and listed credit in particular? Vic has chatted about some of the idiosyncratic risks that we faced and how those have really kind of shot up in recent months. And the global backdrop is not exactly supportive of corporate profitability. And so from a risk reward perspective, one would expect that we should be rewarded for taking on these additional credit risks. But if you have a look at the dynamics of the South African credit market, you'll see a slightly different picture. So the graph that I'm showing here looks specifically at credit risky bank instruments. So we're not going to get too technical. We're looking at AT1, additional tier 1 and tier 2 instruments. The only thing you need to know is that additional tier 1 instruments are more risky than tier 2 instruments. And that is reflected in the spreads. If you look at the axis on the left-hand side, it goes all the way up to 900 basis points. So that's the return that you could earn for taking on these very risky bank credit instruments. Whereas if you look at tier 2, you'll see that the spread on the left-hand axis goes up to 450 basis points. And so what this graph is showing is it's a comparison of what is the spread that we are able to earn on South African risky bank instruments relative to an index of global risky bank instruments. So if you think of all the major local banks, Barclays, HSBC, Deutsche, all of their risky instruments. And you'll see, if you look at the graph, that the trend has been for South African risky bank instruments to provide investors with more of a return for the risks that they carry. And that you can see by looking at the blue dots, the fact that they're above the green line. But what's happened more recently, since around April 2022, is we've seen that the blue dots, the spread, the return that we earn for carrying these risky bank instruments has actually dipped below the global return. So that means that as an investor, you're actually earning less of a return for being exposed to risky bank instruments than if you are holding a global index. And so there's a couple of reasons why that this has actually happened. The first reason really relates to demand-supply dynamics. So Kevin mentioned, growth prospects for the coming year of 0.1%. In that environment, corporates aren't spending on capex. They're not building new projects. They're looking at ways to maintain business rather than grow and expand it. And so the need for credit, the need for lending activity naturally declines. The other significant change that's happened is from a monetary policy framework, the banks have moving from running shortages where they essentially borrow from the SARB at the repo rate to surpluses where they've got a lot of excess liquidity, which they need to put to work somewhere. And repo isn't really going to cut it. And so what do? They start looking at credit markets. And so what we've seen is a significant increase in bank participation in credit. And banks, unlike asset managers, tend to look at returns from the perspective of hurdle rates. Whereas from an asset management perspective, we're looking at return in the context of risk. Are we being rewarded for the risk that we're exposing client funds to? And so these are some of the dynamics that are at play in the local credit market, which suggests that spreads have become very tight, that there are risks that possibly aren't fully reflected in the spreads. And so that doesn't necessarily mean that the asset class is written off as a whole, but it does mean that we need to tread with caution, and that we need to kind of stick to our knitting around our fundamentals and pricing for value, essentially. And so managing credit against this backdrop, what we believe are the key components to building diversified portfolios of credit that provide stable and consistent yield enhancement over time, really is a focus on credit quality. And in this regard, the Income Fund has 66% of its credit exposures that are rated AA or higher. So that's quite a high credit quality, which does well in an environment like this where risk is rising, and the likelihood of defaults generally increases. From a liquidity perspective, unlike listed equities, listed credit doesn't offer the same degree of liquidity. So it's something that we need to monitor and manage quite closely, because the benefit of this fund is that it provides liquidity for clients to be able to move in and out and kind of express views around different asset classes. And so the way that we look at managing liquidity is quite closely linked to credit quality and to concentration risk. We monitor, the ability to dispose of instruments without incurring any trading costs. We also report on liquidity to a number of internal forums, at least on a quarterly basis, where independent members of the business actually review how the liquidity dynamics are changing in the income fund and whether it's fit for the current macro environment. And then in addition to that, we run regular stress testing as well to make sure that we are able to generate liquidity at very short notice if needed. And then concentration risk management is a really important piece of our credit process and the way that we look at managing and mitigating credit risk. And I think it's best spoken about looking at a case study or an example. So I'm going to flip over to the next slide. And what you see on the left-hand side is the exposure of our main funds to SOEs and how that's changed over time. So the purple bars are the most latest period, and then the blue bars are from Jan 2021. The income fund is the one right at the bottom. And what's notable is that the exposure to SOEs has actually declined quite significantly from almost 18% to just under 9%. And this also speaks to the nature of credit risk management and that it's an active process. It's responsive to fundamental changes and deterioration in credit quality, as well as macroeconomic conditions and the view of the sovereign. And so we've embarked on a process of right-sizing our SOE exposure in a number of our funds, particularly in the income fund, to a level that we believe is more appropriate. You might ask, is 9% the right number? What is the right number? And it really does depend. And I keep coming back to this kind of trade-off between risk and reward, because that's ultimately what we're trying to balance in managing credit risk, in that not all SOEs are necessarily the same. You can't paint them with the same brush. It's an incredibly nuanced space. And we'll talk a little bit about Land Bank as well, which is still in default, just to outline some of those nuances. But it really is a matter of balancing risk and return, managing concentration risk in such a manner that a single credit event or default doesn't compromise the performance track record of the fund. And then on the graph on the right-hand side, this is just to demonstrate kind of the rand value decrease in SOE exposure that we've achieved through active management, maturity management. So you'll see our total SOE exposure went from more than 16 billion in January 2021 to just over 8 billion as of June 2023. So turning to Land Bank and really the complexities and the nuances of managing credit in this particular climate, and specifically SOE risk. So Land Bank, as you would be well aware of, defaulted in April 2020. That default is still ongoing. So the work continues on restructuring the debt maturity and finding a solution to return Land Bank to sustainability. But during that time, between April 2020 and current date, what we've done is we've actually reduced, our Land Bank exposure has been reduced from around 3 billion to just under 1 billion rand, and that's on an overall level, not necessarily just in the income fund. And that's really through a combination of actually calling under the government guarantee. So STANLIB was one of the only South African asset managers to have a government guarantee. And so we called on that guarantee in February this year in order to protect the interests of our clients. And that resulted in a return of capital of in excess of 770 million rand. And Land Bank, even though it's in default, and it has been in default for almost 3 years, it's actually been servicing interest for the entire period of that default, in some cases at interest rates of 200 basis points in excess of the contractual rate. And also what we've seen is that 57% of the outstanding capital that we are owed by the Land Bank has in fact been returned to us by the Land Bank, notwithstanding the fact that they continue to be in a default. And so I think the key learnings and the lessons for me is the complexity around managing credit when things don't go according to plan, the depth of experience that is needed to navigate these complexities, and also that just a default isn't necessarily just a default when it comes to SOEs, because it's quite unusual, if you think about it, to have a company that is in default, still paying interest, returning capital, and being able to call on a government guarantee. So it also speaks to some of the kind of strategic important pieces around these SOEs, and how we view them. So on that note, I think I'm going to pause here and hand back to Kevin.
Thanks, Tarryn. Brilliant. Okay, so we've got quite a few questions already, guys. Please send through your questions. I've got 15 minutes, and I think we can deal with some of them. So there's quite a few questions for yourself, Tarryn. I'll ask you one or two, and then I want to ask some of Victor. Before I get to the question here, the two risks that you mentioned, right? Credit quality and concentration risk. Now, if you look at how the income fund is positioned now, would you say that those two risk elements have been, are very conservative right now relative to history, or are a little bit more aggressive? Where would you say you're on the risk appetite scale within the income fund?
Yeah, so from a credit quality perspective, the fund is definitely positioned more conservatively. So what's been happening is that we've been tilting towards higher credit quality exposures just before COVID, and we continued to do that. We've also not been lending to or extending any new funding to SOEs. And so from a concentration perspective, specifically looking at SOE concentration, that's certainly more conservative as well, quite a bit more conservative. And then even if we look at concentrations to other riskier instruments, so I looked, one of the graphs was looking at bank risky instruments, tier 2. So the income fund does have some tier 2 bank holdings, but it's relatively small, and we monitor that very closely as well. So one of the things that we've done is we've actually imposed additional limits on how big this tier 2 exposure can grow to. So I would say that we are certainly more conservative on credit now than we've been historically.
It doesn't seem to have harmed the return, right?
No. Yeah, and that's I think the benefit of scale as well. So what really gives us our edge from a credit perspective is the size of the business. So we are able to negotiate private placements with corporates, possibly at better rates than what we see in the local market. We can be creative in the way that we approach them, and unique opportunities that perhaps smaller managers wouldn't be able to capitalize on. And having a dedicated team of analysts who not only manage the risk, but also look at originating new deals. I think it's finding that balance around deploying capital into credit smartly.
Vic? Yeah.
Maybe just make a comment on that. So for us, the skill is really around finding that optimal space, where you can be able to manage the macro risks, which go with, for example, duration positioning, and then of course, over and above that, the bottom up, analysis that also the credit team, does on the instruments. And as fiduciaries, we make sure that our clients, especially for a portfolio like this, they can go home and sleep without worrying, about what is happening, in the world. So recently, one of the work that we have done, well, the outcome was that there are so many risks. We'll probably may be entering a space where you might end up with a recession. In a recessionary environment, some corporates don't do well, particularly the ones that are lower rated, hence, the quality of the credit, that Tarryn is talking about. And also when you're having volatility, the way, to the scale that I've talked about a bit earlier on, you don't want to disappoint your clients. You want to always give your clients an opportunity to make another decision, including withdrawals, maybe because of the needs that they might have, for their fund. So we try as much as possible to have enough liquidity, at the time of stress. And these are things that we sit down and deliberately discuss. In our various meetings, guys, it's tough times now. Make sure that you don't disappoint your clients. It shouldn't be at the race for returns shouldn't necessarily be at the expense of having major defaults on your portfolio, because there's no comeback. when you have a default, on the fund, So that's that, and I think the results are out there, for everyone to see, including that over the different crises, that we've had, including this rapid rise in interest rates, the COVID environment, where we had to add an extra I mean, in terms of, analysis and the global financial crisis and all of that, this portfolio has never failed, to provide liquidity for its clients, which I think is great.
Okay, Tarryn, we've got a quick, I think you can answer it fairly quick. The question is, which SOEs do you invest in? So you've obviously scaled back, you reduce concentration risk, but which SOEs?
So the income fund currently, the two big SOE exposures are Development Bank of South Africa, so DBSA, that's about 4% of the fund, and then Transnet. So Transnet is around 3% of the fund. And that really is a function of a relative degree of comfort with, I think, the DBSA credit profile. So the DBSA, a development finance institution, they lend to a number of kind of small emerging businesses. They also are quite exposed to the municipal sector. So they've got some municipal debt exposure, and then they also have an African presence. And I guess what we like about this business is that they have really well-managed liquidity. And often when we think about credits, it's not solvency that causes credits to default, it's liquidity. And that's what we saw in the land bank case. So the fact that the DBSA's liquidity profile is very well managed, maturities are spaced out. When we looked at their most recent results, I think they had something like 7 billion rand in cash available, and they were deploying quite well. Sound credit risk management policies as well. NPLs were declining from about 7% to about 5.8%. So you could see real evidence of kind of leadership stability and management strength. Transnet is a tricky one. I think we all are familiar with the issues that Transnet faces. And from a maturity perspective, our major maturities are in 2025, 2024. So that's for the 3% exposure. The challenge, I guess, with Transnet is that the operational challenges tend to eclipse whatever good might be happening from a financial perspective. So yes, you can say they haven't had a qualified audit opinion this time around, or that in fact they have refinanced upcoming debt. They've been able to raise debt offshore. They are paying more for debt, so that's the reality of it. But again, it comes down to this risk and return. So it's around kind of managing the two and saying, how do we manage this Transnet exposure? How do we get comfortable around it, rather than saying fire sale the exposure at any cost just to be able to reduce it? We don't think we're there yet. Okay. Certainly there's a lot of improvement that needs to happen, and we'd like to see faster improvement, but we're not at the point where we're fire selling Transnet exposure, but we certainly are watching it very closely.
Okay, let's deal with two questions, and hopefully we can go through them quite quickly, and then I'm going to ask Vic to summarize. So the question is, it says, recently published data has mentioned that SA banks have seen a lot of bankruptcy events in the SME space. Will this not put pressure on SA bank spreads?
Yeah, so it's a really good observation, and it's certainly something that's come up in the meetings that we've had with the management teams of the banks, where the impairments are kind of reaching the upper end of the target bands that they set for themselves. And in fact, certain banks are actually expecting the impairment ratio to kind of breach that target bank. But when we look at the capitalization of South African banks, they are very well capitalized. They're very well run. So that the regulations that South African banks are governed by, the Basel II regulations, they are the strictest of the strictest regulations. If you compare the likes of a Silicon Valley Bank or some of the regional banks in the US, they weren't compliant with Basel II. They had a much lighter version of regulation. And so South African banks need to do an enormous amount of reporting around net stable funding ratios, liquidity coverage, and all of the big four, I'd say, South African banks are actually exceeding their targets. And so during the crisis, the banks have done very well, and it's unlikely that they'd need to raise a lot of additional capital, if any, in order to deal with the strain.
Okay, now Vic, there is a tricky question here. And the question, I think, says here, some banks offer 13% plus on a 5-year fixed deposit. Some clients will rather avoid any risk in their investments than having any exposure to markets. What is your opinion on this?
So obviously, I mean, that 13%, one would need to break it down, Yeah. So if it's simple interest, then what it means is that it's not 13%, the way that is being advertised, and that's, so I'm not talking down the banks in particular, but there's also a marketing angle, you know what I mean, in the way that those instruments, I mean, are being marketed. But also, you know, away from whether it's 13% or not, the reality is that if you buy a fixed instrument, I mean, vis-a-vis, say, a portfolio that can reprice with interest rates moving higher, the advantage of a portfolio that reprices moving higher is that you get a fully diversified, I mean, exposure almost immediately. You know what I mean? Because there's a wide range of instruments, you know, that we invest in, you know, exposure also, I mean, to different sectors. If you're getting the 13% and you are facing, say, not to say that African bank is bad or whatever, but you're facing one counterparty.
Yeah.
If it goes down, you know, your 13% is a reflection. What you thought is 13% can actually be zero quite quickly. And then the other point, I mean, to make is that when you are in a fixed instrument, you lose the opportunity to make another decision. Because if for some reason today, I think equities are going to do well, and I need to get into the market and participate in the 20+ returns, I mean, that you could get. In order to get out of the 13%, what people don't realize is you have to pay what we call breakage costs. You know, so there's a capital, there's still a capital risk. You know, there's a cash, you know, that comes with that. So I suppose, I mean, maybe what I want to say, you know, to the clients out there is that sometimes, you know, what looks good, it can actually turn out to be too good to be true, you know. So here, for the fund, for example, that we're talking about, advantages, instant diversification, liquidity, as and when you want to invest in the portfolio, and the fact that this fund is managed, I mean, through different interest rate cycles. So at the top, when rates are expected to come down, we increase, for example, the modified duration for the client, and they get the capital appreciation with that. And then at the bottom of the cycle, I mean, when rates are moving from 3.5% to 8.25% now, we cut that duration to, I mean, the lowest was 0.3 years. So you are in a money market, almost like in a money market portfolio. But because we buy instruments along the yield curve, you know, that are offering higher yield, including the credits, I mean, that she has talked about, your yield is compelling, but the risk, I mean, of capital loss is actually very small, you know.
And the thing with liquidity is you don't realize how important it is until you don't have it.
Yeah, exactly.
And then suddenly within those 5 years, you need that liquidity and it's not there. Okay, Vic, I think we've got 2 minutes left. Can you maybe just bring this together? Can you just maybe give us a bit of a summary of what the message is that we're getting across today?
Yeah, and I mean, some of the things I've talked about, you know, which, okay, I'm not going to repeat in detail, I mean, around the fact that you are in a flexible portfolio, you know, where you can change the duration of the fund and limit the capital, and it doesn't matter, you know, whether you are in an environment where other asset classes are experiencing huge drawdowns. You know, in a portfolio like this, and as I showed, you know, your returns profile is much more smoother than you would get, and you're gonna get to a level where even when interest rates, I mean, come down, because you are in floating rate notes, than maybe in a, say, for example, a call, you know, with a bank, your rate doesn't just drop, I mean, the same day. It actually takes, there's a longer leg, you know, for you to be earning that yield of over 10%. We talked about inflation. You don't have to draw on your capital. Yes, it was a bit painful, I think, when rates went down to 3.5%, I mean, for the Reserve Bank, and inflation was actually higher than that. But those are the cycles, I mean, that would come through. And you're also in a portfolio that looks like a money market portfolio, but it gives you, I mean, for the example that I gave you on the yield curve, better returns than you've had. And then maybe, Kevin, you know, the last point, why I'm in a portfolio like this is historically, I mean, you go back to this fund, you look at the different crises, I mean, that we've had, including even the bank one around maybe African Bank, the global financial crisis, where we've had defaults like Steinhoff's, for example, coming through the COVID environment where we didn't even know whether South Africa is going to go to the IMF and all of that. This portfolio has consistently provided liquidity while at the same time, giving clients returns that at times, in times of volatility, have been comparable to other asset classes. So it's a great diversifier, but it's also a great portfolio for those that are looking to earn much more than you would get if your money was sitting in a bank.
Okay, brilliant. I've got 6 seconds to say thank you very much. Guys, we really appreciate you dialing in. As I said at the front, there's a lot of competition out there. So thanks for taking the time. Please, the presentation will be emailed to you. CPD points will be organized on your behalf. The questions were great. As usual, I couldn't get through all of them. So we'll certainly have a look at them over the coming days. But from my side, hope that makes some sense. And we look forward to seeing you on another webinar fairly soon. Thanks a lot.